Good morning. Today on the Brew, we are going to tackle the second order Greek called Vanna, one of Jason's specialties. So get ready for the Trader's Workshop and our chat on Vanna. What's up, lads? How are you?
What's going on, Lex? How you doing?
Same old. Coming off the big summit yesterday, big success.
Yeah, that
really
was
fun.
Those summits are really useful. Like
I like
you get such a variety of perspectives and like trade ideas, and you know, it's really good.
Yeah, thanks. That was it was quite a success. We got great viewership too, so that was fun. Okay, let's get to it. We got limited time today. I'm going to call this Jason's little specialty. You certainly taught me a lot about Vanna. Mark, I don't know how you feel about it, but you know, it's something we always knew about in the trading world and the market maker world. We just didn't maybe call it that. We played with our machine a little bit to get the real deltas. So what do you think?
Frozen. He's paralyzed. Oh no, now he's good.
No, I agree with you. I think I've spent a lot more time thinking about Vanna in my post-market making career than I ever did at the time, right? Like you were exposed to it, like you're saying, different dimensions, different risk modeling, like the effects of it could certainly be seen. But I think the theory on it has come a long way in the last couple of years.
Yeah, I agree. Thanks to guys like Mr. Di Lorenzo, who's big into this. All right, here's what we're gonna do. Let's just go through and define this term for folks. I'm gonna show it. We're gonna go to the slide deck real quick. It's crude, but we'll get through it. And then Jason, you might have some real world examples for us to close it out. How's that sound?
Sounds good to me.
Okay. So let me try to play this. I can't. The problem when I play this, I can't see you guys. Can you guys see this? Does this work?
We see you, and we see the slideshow too.
Oh, how cool is that? Okay. So Vanna, second order Greek. What does that mean, Jason? Let's nail this down right away.
So Vanna is a cross derivative between delta and vega. So in the end, what it means is it is the change in vega with a movement in the underlying price, or it can be the change in delta with a movement with respect to implied or with respect to volatility. There's some people who measure it to realized or some to implied, but you know, it's a different story. Anyway.
Okay, so safe to say it's this it's not this Vanna.
Miss Vanna No. And she actually doesn't even look like Vanna White.
Yeah, that's one of those little emoji things.
Come on, man. And look, come on, what is this?
I know when you do it on Dolly though, they can't do an image of Vanna White. She'll probably sue Dolly or something. So they get the fake cartoon one. What can I say? It's close enough.
Fine.
So Vanna, the main definition I always go with is it measures an options delta sensitivity to changes in implied volatility, and they usually gear it toward a 1% change, in IV. Okay, and you said something else. There's a second definition. What was that again with relative to Vega?
It's a change in Vega, in your Vega position with respect to moves in the underlying.
Oh, okay. I didn't know that was Vanna as well. Mark, did you know that? I didn't know that.
I liked how Jason defined them, that it's a cross derivative, right? So like the direction goes both ways. Like I think that's a really useful way to understand why it's both of those.
Okay. Perfect. All right. So here, and you guys haven't seen these slides, so I apologize. Here's Vanna by strike. So let me get you up to speed fast. The different line colors represent different deltas. There's a 20, 30, 40, and 50 delta. Okay. And if you look at the y-axis, that's implied volatility value. So 0.2, 0.4, and so on and so forth. So what I'm getting out of this is that if you look at the 20 delta option, which is an out of the money kind of deal, it seems to be affected the most by Vanna behavior. If you look at that, implied volatility goes way up there. You can see what that 20 delta does, and so on and so forth. So, Jason, comment on this. I pulled this off the World Wide Web.
This isn't like the typical chart you usually see with Vanna. Yep. Typically with Vanna, you see something that kind of looks like a little bit like a sine curve, and with the x-axis being in deltas and the y-axis being the Vanna at those strikes.
Okay.
Around the 20 delta is where you have the highest Vanna impact.
Okay.
And it's kind of different than all the other Greeks we were talking about when you're talking about like deltas or gamma or vega, where at the money is the highest impact of those Greeks. At the money is actually 0 for Vanna.
Right.
And the large strikes are like at 20 delta or even like 80 delta, like if it's in the money.
Okay.
The other kind of thing about Vanna too, and I don't know if you can imply that from this chart, but Vanna has, when you cross over 50 delta, Vanna changes its sign. So, at 50 delta, it's 0. Below 50 delta, it would be, or like if the current price is below the strike, right, on a long option, then it is a negative Vanna.
Let me say that differently, or let me just make sure I understand. Let's talk about in the moneyness and out of the moneyness, because that's one of the slides. So in the money calls, the Vanna there is what?
If it's an in the money call long,
then
you're looking at negative Vanna.
Okay, because as vol goes up, that delta is actually going to go down, right?
Yes.
Okay, got it. So that's interesting to know. So once you cross over a critical point, the at the money point, and one option goes from out of the money to in the money, things change all of a sudden relative to Vanna. Okay, makes sense. Mark, any comments here?
No, I just wanted to. Well, yes, I do actually have a comment. I want to highlight what Jason said about the where Vanna's the highest, because I think that has some interesting implications for sort of like strategy development and how you want to like set up strikes and whatnot. And so I think it tends to peak right in that like 15 to 20 delta out of the money area, whether it's on the call or the put side. And so from an overwriting perspective, from like a skew capture perspective, targeting those strikes is useful because there is quite a bit of delta sensitivity with those changes in implied vol. So, you do get a lot more deltas at those points from a Greek perspective. Overwrites, like I said, if you're selling skew, like those puts, get a lot more deltas, stock rises. So I think that's that feature of Vanna is important for developing,
That's a good point. Okay. Anything more to say on the strike thing here, Jason? Do you think we got that pretty good?
Well, like you said, I didn't see these slides beforehand, so I don't know if I'm going to start creeping into.
You don't know where you're going to listen. You start creeping in, we're going to creep you right out. Okay. All right, let's go to the next one. I always talk about intrinsic and extrinsic, but we're going to skip that. Here's the only thing about Vanna being terrifying. Okay, I always use this slide. I'm thinking from a more of a GME standpoint, where it can be terrifying. It might be not so terrifying for the retail guy. It might be more terrifying for the pro dealer type. When you have implied volatility that goes probably from in the 50s, 70s to 700, that can be a little terrifying, probably for your position. No.
Yeah, I mean, Vanna is one of those like when you're talking about your own position, Vanna is one of those things that can make your P&L go off the rails a little bit and make it look pretty bad. I mean, but if you have to have a thesis on volatility before you make a trade, otherwise Vanna's going to make it make you scared.
I think it makes me feel this way more. I feel much more. It's more refreshing, I think, for me. I don't know.
Everything's refreshing for you.
That's true. All right. So here's the Vanna files. Time to expiration. How is Vanna pertinent here with going out in expiry? And anything specific chat here?
So kind of like many of the other options or many of the other option Greeks, Vanna increases at that 20 delta, and 20 delta moves. So you're going to see like the curve squeeze a little bit toward the current price. But it at expiration, like at a 0 DTE level, Vanna suddenly goes away because most of that, we're probably talking a subsequent episode about charm, but Vanna is a measurement against the premium of your option. And it's a implied volatility and time both contribute to that. So as time as you get like comes a certain point where the total Vanna actually decreases and the time aspect increases.
Okay. Okay. And then we already talked about Mark and Jason. You said out of the money calls and puts, most sensitive to changes in Vanna. About the 20-ish delta. Is that what we decided? 20, 20, 25. Let's say 15 to 25. Is that the range more or less?
Yeah.
Where it's most sensitive. Okay.
Yeah.
So long out of the money calls creates long Vanna. Is that right? Yep.
Long out of the money calls is that is positive Vanna.
Yep.
Long in the money calls is negative Vanna.
And then long out of the money puts is short Vanna, and long in the money puts is long Vanna.
No.
No.
Opposite. So the kind of option you have doesn't matter in Vanna. And that's because delta moves in the same direction as implied volatility comes down. So like, let's say you have an in the money put, right? And so that would be like negative 0.8 delta, let's say, right? Implied volatility is coming down. Where that delta is not going from 0.8 to 0. It's not going up. It's coming down to -1.
Oh, yeah, but to me, you're getting longer though. Yeah, or that's how I look at it in terms of what it creates. So think about it this way. Tell me where I'm missing this. Out of the money put, you're long. Okay. If implied volatility goes up, that delta goes from a -30 to a -40. That's actually getting smaller delta, but you're getting shorter.
Yes. Yes.
Okay. Okay.
So you're having a math sign confusion there.
Yeah. So I'm thinking of what it does.
In the money though, it would be going up because it would be going from 0.8 to 0.7, -0.8 to -0.7. So the technicality is it's going up, but you're thinking in absolute terms. So
I got you. Okay, I was thinking in delta terms actually. Okay, all right. I'm going to stop sharing because I just am. Okay, so that's all cool stuff. Do you want to go over? Let's take a few minutes here and go over an actual scenario from Vol.
Yeah. But I do want to riff a little bit about and hopefully, if he's not frozen, Mark can talk a little bit about this too. Okay, are you there, Mark?
He could be frozen.
He's frozen. Okay, man. So maybe you could talk about it, Lex. So, from a dealer perspective, in which my true interest in Vanna is more from a dealer's perspective because dealers are hedging their delta, and Vanna is Vanna moves delta. So, what I like, by the end of the day, they try to become delta neutral. So my interest really in Vanna is how it affects your hedging of your option position, right?
Right.
So, like you said, as a market maker at the time, you're probably looking at it and thinking, you knew of the impact, like as implied volatility is coming down, you knew that your deltas would be changing, but you didn't really like conceptualize it into a number, right?
Right.
So we're,
oh no.
Was he drinking soup?
I don't know. But that sounded like he's in a shampoo commercial in the shower. Like
he's back. Mark, you back? Well, let him figure him stuff out.
Good thing Mark didn't freeze during the row presentation.
Right.
But anyway,
a lot of opinions on row. Less so on Vanna.
Yeah.
Getting back to this though, my interest in it is more in how are dealers hedging because they're also not typically dynamically hedging during the day because that's how you lose money. You get whipsawed, they lose all their edge, right?
Yep.
So, my interest in Vanna is more about how the hedging happens against like a dealer positioning. Yeah. And we find that it's between Vega and Vanna, it is a primary driver in like that phenomenon that we notice that like as realized volatility starts coming down and down and down, that it's really Vanna and kind of charm, which I'll talk about later, that keeps the market buoyant through that time. So, and we actually, I'm not allowed to share more than one screen, but we did a study on this in our white paper. You can look it up at www. You could do vol.land. We have it on wizardofops.com. But in that white paper, we had a measurement. We were trying to figure out how to show this correlation most effectively, and we realized that when the aggregate Vanna is maximized, then you're going to have that slow, it's a leading indicator for like that slow bleed up. But then once it becomes, not maximized, like it's not the maximum possible cumulative Vanna, that's when you could start seeing tremors a few months out.
Okay.
So with that in mind, now we can look at Volland.
Okay, let's go to this. Let's go to your slide. Okay. Explain first what we're looking at.
Okay, so this is what Volland is a trade by trade. I guess it's like a trade by trade kind of solid estimate of what the dealer's book looks like, the aggregate dealer's book, not like one or the other, right? And we put it in Greek terms because that's how they're hedging. They're hedging their deltas. The delta, by definition, is how many shares they have to hedge their underlying position. So we put it in notional Greek exposure, right?
Okay. Yep.
This in particular is the Vanna chart. We were talking about, many people kind of recognize that the default customer position is buying puts and selling calls. So that means that default dealer position is buying long calls and short puts, right?
Yep.
And so with the short below the money and the long above the money, you have positive Vanna. That means that the implied volatility and the deltas are going in the same direction. And typically when when volatility is coming down, that means the deltas are coming down, which means they have to hedge bullish, right?
Yeah. Right. And they're always long those out of the money calls, the dealer, they being the dealer. That drift up is typically a vol smash, typically, in which case that dealer's getting shorter.
Right.
Yeah. So you remember those days, right, Mark? Are you with us?
I think so.
Oh, he's with us. He's back.
Okay. Good. I've been holding back.
All
right. I think I totally agree with the dynamics that play. I think one of the muddying factors practically tends to be like the randomness of trades that a dealer's getting on a day-over-day basis, right? Like you could get planted with long or short calls just, randomly based on the wheel, randomly based on who shows up. So I think the dynamic is definitely there. Like whether it plays out is almost like a randomness around what your position might be and how much is your Vanna delta getting covered by the trade that just happened to hit you.
Right.
Yeah. So what we have is a lot of it. So in Volland, we take every trade individual, we ingest the whole Oprah feed, we categorize the whole Oprah feed, and we store. So everything that has, all the existing positions are all in there too. Even though there's a lot of volume during the day, we also capture that in our we have a live feed too. So it's like 5 minutes, every 5 minutes it updates. We noticed that the intraday volume on SPX, SPX is the largest notional traded by far. We noticed that a lot of about half of that volume is intraday, which has a low Vanna impact by definition. And then, there's the existing book, you could say the soft deltas from Vanna are large. Because you're adding to those out of the money or to those longer than zero DTE, you're adding 15 million options every time. So every day. So it doesn't move a lot during the month. It moves close to OPEX, obviously.
Yep.
Like that week out, it moves then. It definitely moves higher as you get closer to expiration. And then, decreases pretty rapidly, in that Wednesday, Thursday timeframe.
Yep.
But a lot of the existing book doesn't change a ton day over day.
Yeah. So
all expirations.
Yeah. So here's what it seems like to me. The Vanna effect here. It seems like an entity like SPX, a product like SPX. It has such massive notional value in terms of trades, right? Trillions, I'm guessing, of stuff. It seems like even dealer Vanna there, it probably has a very limited effect on market movement, because how much Vanna can they possibly have to have those decisions? Even when you add Gamma in and even Charm, it still seems like it's not big enough for that community to really move the market. Now, having said that, take a stock like GME that has much less value. I'm sorry, much less notional, much less liquidity, much less open interest. That's a different story to me. That to me can really be explosive in terms of Vanna, Charm, Gamma in movement of that underlying. What are your thoughts there? Both of you guys.
So considering, I think it just depends on how one-sided the book is. With GME, I think it has a large effect because, you know, in its heyday, like, you know, in the meme stock heyday, Vanna has a very large effect, primarily because you don't, you know, the swings are so wide, that realized volatility is so high that when it starts to come down, when GME starts to settle down, it's, you know, it's going to crush really fast. But with something like GME, it's a little bit different than SPX. In fact, most stocks, individual stocks, are different than SPX in that SPX tends to have a very structured, you know, long from the customer side, long put, short call structure, and they're basically hedging a whole portfolio. The individual equity arena is a lot more speculative. And when you have something like GME, you notice calls get bought like crazy. They're not sold. So it has an opposite Vanna effect. So when you have that vol crunch in GME, those are a lot of long calls, not short calls, you know, from the customer side. So that Vanna crunch actually causes a decrease in that stock, which is why when it settles down, you see GME settling way down. You know, it goes down, you know, 10, 20%.
Yeah, I was talking to one of our Mark's and my professional friends at a firm Mark knows very well, and they trade that, I believe. And when GME turned around and went south, sold off, volatility got hammered. Right, because the whole impetus of volatility there is an upward move. So when it turns the other way, the underlying stock, it just gets smushed, which is an opposite effect generally. Right.
It trades like a commodity, or like
Bitcoin. That's right. Yep. So that's interesting. So I think it's, to me, it seems more profound, Vanna and even Charm to probably a big degree, which we'll talk about next week, with individual names versus a big SPX kind of thing.
Yeah. Well, I mean, in this case too, like you see, you know, our cumulative Vanna here from a dealer perspective is about 40, you know, maybe like 44 billion, which means like a 1 point. I would say it's realized vol typically how this is measured. But there's like two, you know, some people do implied, some people do realized. But so you need that to go down a whole percent for it to realize $43 billion of buying. That doesn't happen very often. And by percent, we mean like points, like a VIX point. You know, if it typically goes down like 0.2 or 0.1 at you know, on decent up days.
Right.
But it continually happens, you know, so that's why you get these like 14 straight days of plus 5 points, you know, or plus 6 points. It doesn't move the market like, you know, it doesn't move the market like a fundamental event or anything where it goes plus 40, plus 50. That's not what Vanna does. It's kind of skews the most likely above current price. But also creates a long tail, because if volatility spikes, Vanna will have a negative effect. So, and the other thing too about Vanna, though, that's interesting is because of the concept where it flips its price, right? Where, or I'm sorry, it flips its sign as price moves past a large strike. Here, you can see these large positive strikes here kind of become a little bit of resistance, because it goes from green and, you know, contributing, you know, 3, 4, 5 points a day, and then it becomes red, and that means that it's contributing less. You know, Vanna has come down. So
So
when I say on Twitter and stuff like that, it's hard to pass this level.
Yep.
Usually it's like these huge spikes in Vanna that I'm referring to.
Right.
And, it's it'll pass it a little bit, but it'll be tough once, it's like walking in snow. It's tough to get.
So,
anywhere.
and here's, and just practically why that happens, right? When you cross paths, when you on a long call, right? Mm-hmm. What happens is that if Vol's going to come down now that call's in the money, that option is going to get more deltas, okay, that call, and it's going to make that dealer longer, in which case he or she or it is going to have to sell underline to hedge that to neutrality, which puts that magnetic effect back at that strike. Is that what you're
correct.
saying? Okay.
Yes.
That makes a lot of sense, actually.
Mm-hmm.
Hi, Mark. Mark, are you back?
I'm back, but I'm on mute.
Oh, okay. Well, I got time for one last comment here. Sorry. Let's go. Let's just go to us real quick. I was going to ask Mark because he was frozen at the time, and Jason, you brought it up. How would you think we dealers dealt with this at the firm level with this Vanna issue? Because pre-computer, we had sheets. We didn't even know what was going on. We had to move our volatilities up and down with sheets and figure it out, right? Once computers came around, we could certainly figure this out by moving implied volatilities up and down. Do you think it's a constant hedge with Vanna for dealers, or is it just, a couple times a day, check things out? What are your thoughts? And then we got to go.
Yeah, I mean, I think broadly, dealers think about hedging their hard deltas, and they think about hedging their soft deltas. Mm-hmm. And soft deltas are the deltas that accrue as a result of Greeks. Sometimes we would shorthand that as gamma, and Jason always corrects me when I say those are deltas from gamma, because there are a lot of other Greeks that also produce deltas also. So right. But generally those soft deltas, I think you hedge relatively infrequently. That maybe it's a noon, maybe it's a close. It kind of depends on the equity. I think, Jason, you've seen pretty systematically that close order in SPX, right? So that is probably a less frequent one. Something that's a crazier stock, GME, you might be hedging those soft deltas more frequently. But then your hard deltas are also coming in by trades. Someone buys a put from you. All of a sudden, you have a bunch of deltas that just came from that put that maybe it offsets what's happening into your position. So you don't necessarily have to worry about Vanna minute by minute because you just got whacked on these calls or these puts. And that's growing around your sort of mix of Greeks or delta exposure anyway. So, and you wanted to keep that overall limit relatively managed during the day. You couldn't just let it run if you kept selling puts and you were getting, deltas from Greeks too. You got to close that at some point. You can't just say, end of day. So I think it really depends on the random nature of order flow too, as much as, some of the
those are good points.
Position evolution factors.
Right. Mm-hmm. All right, let's do this. Let's run because we got to cut. And then let's pick up the end of Vanna on the next one, which the real topic will be charm. Okay. For next week. And then we'll finish kind of last thoughts on Vanna next week, if there are any. And
all right,
get into charm. You guys have a great rest of the day and have a great weekend and long weekend, right? This is when selling premium if the market doesn't move is great. 3 days of a weekend. Holy cow.
Selling premium if the market doesn't move.
Yeah, I know. I have a crystal ball. Didn't I tell you? I have a crystal ball. I know when it's not going to move.
Just don't sell calls.
Just don't sell calls. That's right. All right, kids. Have a good one. Great show.
All right.
Thank you. On the Brew. See you, boys.
All opinions expressed by Tradier Hub contributors are solely the contributors' opinions and do not reflect the opinions of Tradier nor its affiliates and or subsidiaries. You should not treat any opinion expressed by Hub contributors as a specific inducement to make a particular investment or to follow a particular strategy, but only as an expression of their opinion. The contributors' opinions are based on their own personal research, but neither Tradier nor its affiliates and or subsidiaries warrants its completeness or accuracy, and it should not be relied upon as such. Any trades or positions discussed or referred to by contributors may or may not be actual live trades or positions. Such information is not intended to be financial or investment advice. Tradier Inc. is the parent company of Tradier Brokerage Inc. Tradier Brokerage Inc. and Tradier Inc. are separate entities with their own products and services. Securities products and services are offered through Tradier Brokerage Inc. Tradier Brokerage Inc. is an independent subsidiary of Tradier Inc., all rights reserved, member FINRA SIPC.